currency pairs as well as stocks, close to 30 points in just about 3 or 4 days being long a particular signal that we posted on that. We also post signals in the forex currency pairs as well as stocks, so feel free to follow us on Twitter. Now, our sister site, which is Pro Trader Strategies, they market and promote all of my different strategies and techniques. They have also put up a Facebook account, so you can like us on Facebook, simply logging on there and then typing in protraderstrategies.com. There we post a lot more information, more in detail, more videos, a lot of free, great information. So a lot of ways in which to get access to what I teach. All right, here's what you're going to learn today. Remember, this is going to be a really jam-packed. So what I'm going to be teaching you today are basically the common Bollinger Band uses. This is the way 99.9% of most people apply Bollinger Bands. There's nothing wrong with that. It's a great technique. It's a great tool. But we're going to step it up a notch and show you some proprietary settings, how you can change the settings. And this leads to one of our best continuation strategies, which I'm going to teach you today in its entirety. That's strategy number 3A. Now, because this is going to be run like a class, I know a lot of you like to go to presentations where you ask questions during the presentation. Well, I would rather have it that you just wait till the very end. The class seems to go a lot smoother then, and often if you wait for the next slide, your question will be answered. So I know we have limited time here, so kindly just wait off on the questions to the last 5 or 10 minutes, and then I'll answer everything, okay? All right, so let's review right off the bat by what common use is for Bollinger Bands. Remember, they're a very great tool. We have nothing against Bollinger Bands. In fact, you know, we have strategies that are based off Bollinger Bands. I believe in Bollinger Bands, but there's a few, I would say restrictions when using the standard use. Now, here's the standard definition. Bollinger Bands consist of a center line. This is basically just a moving average, and 2 price channels. These are the bands above and below that center moving average. Now, when the markets become more volatile, in other words, when there's a lot of movement, these bands will widen, all right? They'll move further away from each other, further away from the mid-moving average. And when the market is volatile, the bands will contract. In other words, they'll move closer to the moving average. Now, the tightening of the bands is often used by technical traders as an early indication that that a lot of volatility is about to increase sharply. So this is a great tool to tell you that most likely there's going to be a lot of movement coming in to the markets. So if we look at a standard chart here, we see that we have the Bollinger Bands plotted on this, and at this point we see that the top line is coming lower and the bottom line is coming higher. So they're contracting, they're getting tight, and it was followed by some really nice volatility, some nice movement to the upside. We see that we have the Bollinger Bands also applied to this. At this point we see that price bars here, or the Bollinger Band bars, are headed lower, where the bottom one is headed higher. So you have this contraction right here, and we had more volatility to the downside. You also saw that right here. All right, so it's a great tool that should signal there's going to be some movement coming in. The only trouble is, which direction is it going to be in, and how volatile is that move going to be? Is it going to just last a few bars? Is it going to last for weeks or not months? We're an educational company. We want to teach you how to trade so that you don't have to rely on an outside source telling you what to buy, what to sell. You don't have to log on to some website each and every day to tell you what to do. It's our opinion that that's why most traders fail, is because they basically take themselves out of the game. They're trading without a purpose. They're just relying on someone or something else to tell them what to do. So we want things that are cut and dry, that every trader will be able to see and come up with the same exact scenario and then enter at the same spot if they like. So this brings us to strategy 3A. This is the strategy I'm going to be teaching you today, which uses and has a heavy reliance on the Bollinger Bands, but with a twist. So let's talk about some of the highlights of this particular strategy. It's a continuation strategy, meaning that we're not trying to buy on a bottom or sell on a top. We're simply waiting to see that some trend has been established, and then we wait for it to kind of pause or stop for a bit, and then once it continues, that's when we jump on board. Very similar to a train leaving a train station. So rather than just jump on board the train, we want to see that it's going in our direction, and that's when we jump on board the train. Now, it uses a unique Bollinger Band setting. We're not going to use the standard setting for Bollinger Bands. It's designed to trade quick, powerful trends, and we're going to show you different ways in which you can stay in it either longer or you can just get in and out rather quickly. Now, this works in any market, in any time frame. So even though this is, FX Street, I'm going to show you some Forex currency pair examples that work fantastic. But I'm going to also show you how it works well in stocks, how it works well for intraday trading of the futures. So if you like to trade multiple markets, you can apply this to virtually any market and any time frame. Now, obviously, you're going to get more signals if you intraday trade. Why? Because of the relativity factor, you're going to get a lot more bars intraday trading, so you'll get a lot more setups. Obviously, if you trade weekly or monthly bars, you get less setups, but they're going to be just as valid, all right? As with all of our strategies, since we're an educational company, since we don't just want you to blindly take signals, once again, that's a recipe for disaster if you don't know what you're doing. We want you to take this strategy and then paper trade first, okay? Paper trade it so that you really fully understand the basis of it. And when you fully understand the process, then we want you to jump on board, okay? Then we want you to start trading it with actual capital, but trade it, at very small first, very small units. Our edge at specialist trading is consistency. I know some educators, some website promise the world. They promise that you're going to be making hundreds of thousands of dollars the first year. We don't do that. Remember, we're an educational company. Our goal is just to get you consistent, because consistency is what's going to make you sustainable. In other words, consistency will make you trade 20, 30, 40 years down the road. I've been trading for nearly 40 years, 38 years to be exact this year. And the only reason I've been able to sustain myself is by using techniques and approaches that are consistent. So this is what we want to instill in you. We're not going to give you some fly-by-night system that produces 100% results. We don't believe in that. We believe that you should be trading 2 steps forward, 1 step back, okay? So I see some people are saying there's some volume problems. I believe there were volume problems in the last presentation. I think this is something that has to do with this particular platform. But just bear with us. And I know this is being recorded, so possibly if you aren't able to hear everything, just kindly refer to the presentation that will be recorded, and you can check up with that. All right, so let's look at the indicators we're going to be using for this, okay? We're going to be using 2 indicators, a 50-period simple moving average. If you followed my presentations before, you know that I apply that to virtually every strategy we have. And then we're going to use a 20-period Bollinger Band settings, all right? But we're going to change them a little bit. Now, the standard Bollinger Band moving average, in other words, that's the mid Bollinger Band we described earlier, is set at 20. We're going to keep that at 20. We're not going to change anything. So the moving average in your Bollinger Band setting will remain at the standard default at 20, as you see here. Now, the upper band and the lower band settings are going to be altered slightly. Those are usually set at +2, meaning you're going to be, the deviation is going to be +2 away from the middle line and -2 below the middle line. We're going to kind of alter that to read 0.382 for the upper band and -0.382 for the lower band. All right, so that's the standard deviation. We want to be away from the mid moving average, the mid band. All right, now I know a lot of you may say, well, what's the significance of these numbers? I realize there may be a Fibonacci number. Is there something magical and mysterious to this? No, it's just over time I was taught this technique on the floor of the Pacific Stock Exchange, and this is what was taught to me. Okay, they just said there's a nice smoothing effect when you use these numbers. There's nothing magical or mysterious about this. Now remember, if you have trouble doing this and you don't know how to go into your edit box and edit these bands here, call up the tech support of your software charting package, and they should be able to set it up for you, okay? All right, so that is the setting. We're going to keep the Bollinger Band moving average. That's the middle band at 20. Nothing will change there. But the upper band deviation be set to +0.382. The lower one should be -0.382. That's just telling you the distance away from that middle Bollinger Band. All right, so let's go by the rules step by step. I'm going to show you a lot of slides, so don't worry if this seems a little wordy at first or a little complicated. Don't worry, after a little practice, it should be extremely simple. All right, step 1, your entry price must be above the 50-period moving average. In other words, An ideal scenario, as I'm going to show you here, would be for most of the bars, the majority of bars, to be above the 50-period moving average. By the way, this is if we're going long. We'll just reverse these rules if we're going short. But if we're looking for a buy setup, an ideal scenario would be for the majority of the bars to be above the 50-period moving average. But in all actuality, all that is required is that our entry be above the 50-period moving average. And I'll show you in just a few slides going forward what that means. But if we look at this chart here in the E-mini, remember, this is just for example purposes, for educational purposes. This can be applied to any market, any time frame. Here's a 5-minute chart of the E-mini. We see here that the majority of prices are above the 50-period moving average. Okay, so this tells us we're looking for buy setups. We will not in any way, shape, or form look to go short if we enter to go long above, or if we enter our trade above the 50-period moving average. All right, all buy entries should be entered above the 50. All sell entries should be entered below the 50. Now here's the moving average, or I should say, here's the Bollinger Bands, how they're going to look once you have applied that nice setting. You see how we've really smoothed out. There's no more fits and starts and contractions here. We have a really nice, smooth moving average. All right, step number 2. We're going to look to buy when 5 consecutive price bars, so it must be 5 in a row, close on or above the highest Bollinger Band. So if you looked at that Bollinger Band setting we had earlier, we want to see 5 bars close above, on or above that top Bollinger Band and create a pivot high, all right, create some type of short-term top. This short-term high will be labeled the setup. Now, if you're not sure what a pivot high is, it basically looks something like this. In other words, if we have 5 bars here in this ideal, see that we've created a couple of highs, we have a higher high, and then we have lower highs. So we have kind of this arrowhead look right here. Now, this is an ideal scenario. This could be just 4 bars or 3 bars. It doesn't matter, but you want to have this kind of a high, followed by a higher high, followed by a lower high. That's a short-term pivot high. Obviously, a short-term pivot low would just be the reverse. So as you see here, we have 1, 2, 3, 4, 5 bars that consecutively closed above the highest Bollinger Band. Okay? And we created this short-term pivot high. All right? So this is a setup. This does not mean we're going to buy at the market. We just have a valid setup to go long. Step number 3, we're going to enter the buy when price trades 1 tick or 1 pip above the short-term high, that little arrowhead we just located. Now, here's the one caveat, the thing you have to remember. Since we're looking for momentum, since this is a continuation trade, we want to see that the price bars stay up in a relatively high fashion. In other words, we don't want to see price sell off that much and close below the highest Bollinger Band, because if the price bar closes below the highest Bollinger Band before we enter, well, then the trade is negated, the setup is negated. All right, we're not going to look to buy if we trade above that little short-term top, because we're looking for momentum. And if we close below that high Bollinger Band, well, most likely we've lost momentum. All bets are off. So we just wait for another setup. So in other words, here's our setup right here. We have 5 consecutive closes above the top Bollinger Band. Do a lot of fundamental analysis, and you thought heating oil is going much, much lower. Well, if you're a more advanced trader, you can not only exit at 200 and 300% range extension, remember, once you decide what the 100% is, but you can also exit at 400%. But that's the most we would say you can ever use. We advise most of our students in the beginning of this to exit at 200%. So once again, if we're trading stocks, we're going to use the same rules if we're trading E-mini futures. And if we're trading E-mini futures, we're going to use the same rules if we're trading currency pairs. So here's a 30-minute chart of the E-mini going back about 3 weeks ago. Prices above the 50 period. We want to have 5 closes above this top Bollinger Band. That's 1, 2, 3, 4, 5 closes, as you see right here. All right, now we just need to find a short-term top, and that's right here. See that top that was created? So if we trade above this before price closes below, see here we went below, but we did not close below there, well, then it's a valid setup. So we went long at 20.20. All right, this was just about 3 weeks ago. Placed our stop just below the lowest short-term low. Once again, this is a lot of risk. So if this is too much for you, well, then you don't trade 30-minute charts. Trade a 5-minute chart. Trade something else. Now we decide what the risk is. because or I should say what the range is, we take where the high was of that pivot to the low. That's 100%. And if you wanted to get in and out quickly, you would simply enter exit at the 200% range, which would give you 22 points in just a few days here, just one day actually. That's $1,100 per contract. Once again, see how simple this is, because we're only following one thing. That's the market. We're not listening or relying on anything else to tell us what to do. How about a 5-minute chart? Okay, this was on the 3rd. This was just a couple of weeks ago, and price is above the 50-period moving average. We want to have 5 consecutive closes above, 1, 2, 3, 4, 5 consecutive closes, and we see here that we have this short-term top. So this is our point of entry if we trade right above here, which we did. So there's our entry at 2030. We go to the first short-term low, which would be right here around 2026. So we're risking about 4 points or so, okay? So risking 4 points, that's a couple of $100 per lot. That's okay. Most people could take that. We simply measure the range now. Here's where the top was, and here's where the rally began. So here's 100%. If you wanted to exit at 200%, we could have exited in the next 20, 30 minutes and made a quick 6 points. So we're roughly risking 4 points to make 6. All right. If you wanted to exit at the 300% range, you'd exit here at 42 and made 12 points. Okay, you're roughly risking 4 points to make 12 points. Let's look at the Forex now. There's a lot of examples in the currency pairs which I want to share with you and show you actually a current setup that may be developing at this very moment. Let's look firstly at a longer time frame just to show you how this works in any market, in any time frame. Here's a weekly chart of the euro dollar. All right, now coming into this, we see that price is above the 50-period moving average. Now we had 5 closes above here, but then we closed below, so there's no setup. And we count again, 1, 2, 3, 4. Now the next bar closed below the highest, so there's no setup. Now we have 1, 2, 3, 4, 5 consecutive closings below the Bollinger Band. All right, and we created a short-term bottom here. And this was back in July of last year. Now, this is a valid setup to go short, but it must trade below that, which it did at 35.01. And you would have placed your stop right up here, roughly around 37. So you're risking a couple of hundred pips on a weekly basis, which is not that bad. So all we do now is measure the range from where the sell-off began to where that short-term bottom was. That's 100%. And if you used all of the different exit points, 2, 3, and even 400, if you were a more advanced trader, you could have racked up nearly 1,500 pips by the time we got to January of this year, okay, just last month, all right? We're talking about roughly $15,000 per lot, just using this simple technique. We weren't interested in anything that was going on globally. We weren't interested in any news. We didn't care about any so-called support and resistance. We were not trying to trade Fibonacci levels. See, there's no consistency in those ways of trading. They will work every once in a while, but when they stop working, mostly you give everything back. In other words, had you tried to pick a bottom based off some support level in the euro dollar this last 6 months, you would have lost a lot of money. Wouldn't it have been better simply to find the trend and go with it? Don't worry about support and resistance. You know, there's some people that make very good money trading that way, but it's very difficult to teach. All right, it's very difficult to explain rules without being subjective and putting a lot of guesswork in there. Much easier just to listen to what the market's doing. Once the market gave us this signal right up here to enter, once we broke that, that's all you needed to know. There was nothing else. You didn't need to know any fundamental news, anything globally. It doesn't matter. The market will do what it wants to do. Our job is simply to listen to it and jump on board. You see, trading is really simple, regardless of what market you're trading. It's only the trader who makes it more complicated than it has to be by throwing in all this convoluted logic and plans and rules. It's overcomplicated. Follow the market, and then you'll be able to achieve the consistency you've been striving for. Excuse me. Now we see this is a weekly chart. We realize a lot of people don't trade the Forex currency pairs on a weekly basis. All right, so let's go down to a 15-minute chart. Now this was just looking back here. If we see here on this was on the 12th, as you see right here on the very bottom. So this was just this past week here, about 3 or 4 days ago. Now on a 50-minute time frame, we have 5 consecutive closes above the top Bollinger Band. 1, 2, 3, 4, 5. all right? We've also located a short-term top. We have a high, followed by another higher high and a lower high. So this is a short-term top. If we trade above there by 1 or 2 pips, that's our entry signal, which we did. We entered at 1338 and placed our stop down here about 1310. So we're roughly risking about 30 or 40 pips, all right? After all, we're only trading a 15-minute time frame. So we measure the range now. The range is where the top of that first stop was to where the rally began. That's 100%. Now, if you wanted to take a quick profit, you would have exited at 200%, and you would have made roughly a quick 25 or so pips. If you wanted to exit at the 300, you would have exited at 1392, okay? And made about 50 or so pips. And lastly, if you wanted to take the 400% range exit, look how we got right up there and then stopped the trend, okay? We went up there, stopped. But you could have made a quick 82 pips in roughly about 3 or 4 hours, made $800 per contract, and then you're out for the day. How about a daily chart of the Australian dollar? Once again, everyone's been looking at this saying, boy, this has been going terrible. We've really gone low. The Australian dollar is just getting killed. The only way you've lost money trading the Australian dollar is by trying to pick a bottom, by using some support level or a Fibonacci number to tell you that it's going to stop here. Once again, that's a recipe for disaster. That'll work great until it stops working to give everything back. Because price is below the 50-period moving average, the Australian dollar is telling us it's going lower. And because we have 5 consecutive closes below the lowest Bollinger Band, it's telling us that we have a nice setup to go short here. Now we have here's where we located the first pivot low, okay? Because we had 1, 2, 3, 4. Here was our 5th bar. So here's the first pivot we created after that. So all you had to do, and this was in December, this was beginning of December, just a few months ago, sell at 84.78. Here's where your stop would be, right here, roughly about 86.50. So you're roughly risking, once again, maybe a couple of hundred pips at very most. So we measure the range to tell us where to exit. Here's where we entered roughly here on this short-term low. Here's where the sell-off began on this little range here. Here's 100%. We subtracted to 200. You could have exited at 81.63, basically in just a couple of weeks, still in December, or 300, which was just at the beginning of February or end of January down here at 78.47, and made 631 pips in just a few months. Once again, simply by listening to the market. Now, let's go to a monthly time frame, okay? Let's look at the Canadian dollar. We all know the Canadian dollar has just been screaming to the upside. As we see here, going back to the beginning of 2013, it was below its 50-period moving average. So we try to count and get 5 consecutive closes either above or below, but nothing is happening. So do you see the beauty of the Bollinger Band? It's keeping us out of doing anything because we can't count 5 consecutive closes either above or below. But at this point, we start to get couple, but then we go back below, so there's no trend. But here we have 5 consecutive closes. 1, 2, 3, 4, 5. And even though we touch this, the closes are above the top Bollinger Band. So this is a setup, as you see here, with 5 consecutive closes. And as we can see, we created a short-term top. Here's a high, followed by a higher high, followed by a lower high. So that's our short-term top. This is our setup to go long. But we have to trade there before price goes back down below. As you can see, it did. So you would have entered roughly in November of 2013 at 609. Here's where you would have placed your stop. Actually, you could have placed your stop here, much better level. I'm sorry. We just kind of gave you the maximum stop there. But we measure the range from top to bottom where the rally actually started. There's 100%. You simply double that. Here's 1584. This is where you could have exited in November of last year, and then all the way up here to the beginning of this past month at 2559. Now, once again, these are monthly charts. Do you know how much was happening on each month of these bars here? There was probably news coming out. There was things going on globally, economic indicators, economic adjustments being made in all the countries. It doesn't matter. All we need to know is the trend, and then we just jump on board and use these different techniques for entry and for exit. Now, these are all scenarios that have happened recently. Let's show you something that's happened within the last couple of days. Here's the British pound, okay, on a daily time frame. we've had probably a setup going on here, but as we get into February, we have 1, 2, 3, 4, 5 consecutive closes now above the top Bollinger Band, but we're still below the 50-period moving average. But we have 5 consecutive closes, 1, 2, 3, 4, 5. And if we look at this short-term top that was created here, there's a high, followed by a higher high, followed by a lower high. This is a short-term top. Now, if we were to enter onto this trade, where would our entry be? It would be right here, and that price happens to be above the 50 period. So this is a little bit more advanced trade, but it's still a valid setup. So using this, we would have gone long, I believe, just on Friday at 53.52. Using this technique, you are now long the British pound. Your stop would be right here, just below this lowest short-term low. So using the same technique, we just apply where the 100% range would be, where the rally started. Your first exit would be at 57.15. Your next exit would be at 60.79. So this technique is telling you that you should be long the British pound on a daily time frame, unless you get stopped out roughly right here. This would be your stop placement. Okay? So I invite you to watch this trade. Using this, copy down these exit points. 57.15 would be the first one. We're making roughly about 500 pips, or 3, 4, 5, 6, 7, about 400 pips. And the next one would be roughly about 60.79, about 700 or 800 pips. That's how simple it is, and that's all you have to do. So I invite you to watch this. Now, obviously, we're not guaranteeing you and promising you that this is something, and we're not telling you to go long the British pound. We're just inviting you to watch this setup, because according to this strategy, it has already generated a buy signal that went long at 53.52 in the British pound. And there's where your stop would be, just below right here, the first short-term pivot low, roughly about 52.20. So the risk is roughly about 100, 125 pips, okay? So let's recap before we go into the question and answer portion of this presentation. We shared with you the highlights of strategy 3A, gave you all the rules to this continuation strategy. You see how we weren't trying to buy on pullbacks, or we weren't trying to buy on a low within a trend or sell on a high within a downtrend. We're simply waiting for the trend to be established, and then once we break out of that short-term top, we buy. Once we break below that short-term bottom, we sell. All right? Now, we apply a unique Bollinger Band setting. Most Bollinger Band settings are just your standard default. What we've done is edit the distance the top band will be from the middle line and where the bottom band will be from the middle line. Those numbers are 0.382 and negative 0.382. If you're having difficulty putting that together on your charting software package, call your tech support. They should be able to set you up with that. As I just shared with you numerous examples, this is designed to trade quick, powerful trends. You can exit very quickly if you'd like at the 200% range extension. You can exit at the 400% range extension. And the more intraday trading you do, well, you're going to get more signals. Obviously, if you trade monthly bars the way I showed you in that Canadian chart, well, you get less signals, but you'll have more risk but higher profit potential. Okay? But our philosophy is learn the strategy first. We don't want you, I know your eyes are probably lit up right now thinking, boy, this is amazing, but learn this first. With all of our students who have paid hundreds of dollars for this strategy, which I just gave you for free, we ask them to learn this like the back of their hand, to learn it by paper trading so that you understand how it works in real time, but without actually applying any capital. So paper trade it so that you really fully understand the process. And then once you do understand the process, then go small. Trade one lot, one contract, trade the E-minis, but trade very small with odd lots so that you fully understand in real time with real capital. Now, I know a lot of educators, a lot of presenters are always promising the world. They're always saying, oh, trade this and you'll be able to make millions of dollars by the next couple of years, or you'll be able to trade for a living. We don't promise or teach that at Specialist Trading. We are first and foremost an educational company. The reason we feel most traders lose is because they're uneducated, because they want to take the simple way out, which is basically, well, just tell me what to do. I'll be a subscriber to this site, or I'll subscribe to this chat room or trading room, and whatever they're doing, I'm going to just mimic it. And that's the reason why most traders fail. You've taken yourself out of the game. You haven't put the work in to really make your own decisions. But once you do that, it's our belief that that's what will get you on that road to consistency. by making your own trading decisions. Most of our members and students of specialist trading stick around for a month or two. They learn the strategy, they learn the technique, and then they just basically go on their own. There's no reason for them to be with us. You're a member for life and one of my students for life. So you can always come back and get a refresher course, but you don't have to stick around. This is not something where you have to rely on me to tell you what to buy or what to sell. You already know what to do. All right, so that's what we want. All right, we're more of a mentoring company where we teach you to make your own decisions. Now, in closing here, I want you to ask yourself, I showed you a lot of great free information today that you can start using very soon. Ask yourself, do you think any of the edges I shared with you today, the setting with the Bollinger Bands, the 50-period moving average, the entry techniques, the stop techniques, the exit techniques, do you think they could have helped your trading this past year? Do you think any of them, when you applied your trading, could have helped? You know, look back at your personal trading right now. How are you doing? Are all the courses or all the chat rooms and trading rooms that you've paid to go to or apply to, are they helping you at all? All right. Are you a better trader than you were a year ago? All right. Now, I know I just showed you the basic standard way to trade strategy 3A. We didn't talk about advanced entry. We didn't talk about advanced exits or stop placement. I know a lot of people were saying, well, once it's going in your direction, how do I move my stop up? All right, that's all in the course. We just gave you the basic format for trading strategy number 3A. Now, we're giving all the attendees today a great 2-for-1 attendee special, okay? This is combining strategy 3A with its sister strategy, which is strategy 3. And in my opinion, this is a better strategy because it's a pullback strategy. I just gave you a continuation strategy, but strategy 3 is a pullback, meaning that you'll buy lower prices in an uptrend and you'll sell higher prices in a downtrend. Let me show you some of the current signals. Here's one in BBBY. As you see here, it looks as if most people would say, well, we're in a downtrend here. We're actually selling off. But strategy number 3 generated a buy signal on, I believe, the 20th of, I believe that was January, and look what happened after that. Okay, same thing with sell signal in Tesla. This was in December. Everyone thought, well, Tesla's going much, much higher. We've got a nice rally going on. But strategy number 3 will sell at the top of pullbacks. And look at the nice sell that was generated here. Okay, strategy number 3 also uses the Bollinger Bands, but it uses it in an entirely different way. Here's a 2000 tick bar chart of the E-mini. And this was just going back about a couple of weeks ago. As we see here, we had a small pullback. Strategy 3 generated a buy signal, and look what happened in the E-mini. You can also apply this to intraday trading and 60-minute charts. Here was a nice rally in the E-mini. This was also just a short time ago, and look what happened. A very nice sell signal was generated to go short the E-mini. Lastly, we can also use this for currency pairs. We talked about the Canadian dollar. Now, had we used the Canadian dollar example on here, sure, we would have gone long, but probably we would have used 3A and gone long somewhere around here. Using strategy 3, we would have bought towards the bottom and captured all this move using strategy 3. So to get all of you, the availability to become members of Specialist Trading, we're offering a 2-for-1 strategy pricing. This is a discount, but once again, if you're interested, kindly go to the microsite that FX Street has furnished for us. There you see in blue is the link. Abbreviated right below here is the abbreviation link, and it'll take you to the same spot. Once again, we'll give you more information and more details about the current discounts that you can pick up with any of our strategies. All right? Now, for more information, you can also contact our sister site, Pro Trader Strategies. Remember, once again, they have our Facebook page, and they market and promote all of my strategies. You can email them at trading@protraderstrategies.com or call them directly at area code 310-598-6677. And you can ask about that 2-for-1 attendee special for all the FX Street people for getting strategy 3 as well as strategy number 3A. 3A is the one I taught you today, but you're also going to get a lot more information about how to track the trade, how to use different exit levels, how to just fine-tune the trading of strategy number 3A. Okay? I want to thank you. I know I kind of rushed early with this, but I wanted to give you all that information. We have about a good 5 or 10 minutes left for any questions. So let me open up the chat box. If you do happen to have any questions, let me see here. I realize I see some of the people were looking at a sound problems, and I'm sorry about that, but I realize that I hear that there were sound problems with the presenter prior to me speaking, so I think that may be something internally here, but I hope you were able to hear everything. And if you weren't, all you have to do is simply look for a video that I believe FX Street will make a recording of this, okay? Let's see, Cable says, you're looking at a reversal here rather than trending. Well, Cable, I think you're talking about strategy 3. Yes, that's exact. I don't know if you heard what I said. Strategy 3 is a pullback trade, okay? Strategy 3A is a trending trade, all right, which is what I spent a good 40 minutes talking about. But the last examples, I don't know if you heard, I said strategy 3 is a pullback. So therefore, we're looking for the bottom in an uptrend. We're looking for the top in a downtrend, okay? That's what a pullback is. So in case you came in late or something, that's what strategy 3 is. So there are two entirely different strategies that you're getting for the price of one, all right? One is the one we went over in its basic form today. The other is a pullback strategy, okay? Any other questions that you may have? Remember, you have all of the rules to this particular strategy we went over today. So you can begin using it as early as you like, but as I always suggest, please remember to paper trade first. You know, many of our students have paid good money for this particular strategy. They've paid hundreds of dollars for it that I just gave it to you for free. But that's called a pullback in an uptrend. That is a pullback trade. So there are two entirely different ways of trading, as Cable noticed, and there are two ways of just listening to the markets, okay? Any other questions while we have time here? I want to thank all the good people at FX Street for giving me the opportunity to speak, and I want to thank you for attending today. I have one more question here. How do we determine even? So let's say you have a 50 pip gain, all right? You sell a portion of your position with that at that 200% range extension, and the other half, you just basically move your stop to break even where you originally entered into the trade. Now, once you get to the 300%, you could either sell everything there, or you could move your stop up to now the 200%. There's lots of different ways to use this, and this is what we teach in the course. But it's a way of tracking. We also teach you other ways in which to track as well, okay? Next question says, when you make a pivot top and want to go long, isn't it better to buy a pullback instead of a pivot top breakout? Well, that's a good question. There's no isn't it better, because as you can see here, I just showed you a good 20 examples of how it works. So if it wasn't good at all, we wouldn't have shared that with you. But there's no better or not. It's just what fits your trading style. Now, some people just have the psychological feel where they say, you know, I would rather buy at a cheaper price. If that's what makes you feel comfortable, then strategy 3, the one that Craig noticed, which he thought was a reverse, is a pullback trade. That's the one you should be looking for, because we have many strategies that trade pullbacks, all right? And if you feel like, well, I just want to capture that trend before it takes off, well, then you trade what's called a continuation trade. Okay, and that's where you take, you can use that. The beauty is we're offering you both of these for the price of one. So as I stated, contact Pro Trader Strategies or go to that microsite that FX Street has put together, look at the discounts available, and you'll be able to see a lot of information. Now, someone is saying here that the web page shows strategies 4, 5, and 6. Yes, those are probably our most popular strategies because they work well and transfer over into all markets and time frames, and they work extremely well in the Forex markets. But they're not giving you 2-for-1 deals here. But with strategy 3, we're offering you 2-for-1. So it may be better to send a quick email to Pro Trader Strategies, okay? How does the 2-for-1 work? Someone's asking, are these in addition to number 3? No, in other words, what you're going to get is the full class for all I explained in the last 45 minutes was a real brief explanation of strategy 3A. I give you that along with strategy 3. And even though you've learned the basics, there's so much more to learn about 3A. As one person was asking, how does the, in other words, how do we track the trade? How do we know when to get out? We go into detail about that and how you can trade it differently in different approaches. So there's a lot more that you can learn in that particular course, video course. As well, we give you the pullback strategy, which is, in my opinion, an even more consistent strategy because you're buying at a more inexpensive price and then price is pulling back to that level, okay? How how much does your strategy work? In other words, a percentage from Linda. Well, Linda, if the only way we can give you that number is if it were a system, because the difference is a system means that you trade everything the exact same way, regardless of the time frame, regardless of the environment, regardless of market. So therefore, if everything is traded the same way, we can come up with percentage numbers and statistics. But strategies are different. Strategies give you a little bit more leeway or discretion. Just like I said earlier, you can decide to get out at 200%, you can get out at 300 and sell half your position. There's a million and one ways to trade it. So we can't give you numbers. We're not a statistical company. I said in the first opening statement, we are an educational company. We really don't believe in statistics. That's why we're required to show you that there's no proof that anything will be repeated, because systems have no proof that they will give the same numbers. So that's why we want you to become a part of the process, so you can become and make your own decisions and rely on your own decisions, as opposed to thinking, well, I purchased this system, it's supposed to be 90% productive, and I've only made one winning trade out of the last 20, all right? Because you're relying on an outside source. We're more interested in you making your own decisions so that you can come up with your own results, okay? Alan says, thank you very much. Admire and love you and bless you. You're more than welcome. I hope you do well as in trading the Forex markets as well. Strategy number 5. This is a question on an entirely different strategy. How frequent are the signals per week? Well, actually, it depends on what time frame. If you're looking at currency pairs, on daily bars, are you looking at 4-hour bars? Are you looking at tick charts? Are you looking at, it all depends. The best time frame, the only thing I can say is the best time frame is the one that makes you the most comfortable. In other words, we have some traders, this is where I talk about you becoming a part of the process. We have some traders who love to trade 20 times a day. We have other traders who only want to trade once a week. So there's no right or wrong. There's no how many signals to provide per week other than what makes you feel comfortable. So if you're trading daily bars, you're going to get so many signals per week. If you're trading tick charts, you're going to get so many. It all depends, okay? All right, you have to pick the time frame that suits your lifestyle, because once again, that's what's going to make you consistent. Never, in our opinion, try to mirror or mimic what someone else is doing, because if that worked all the time, then the majority of us would all be successful traders. It doesn't work. In my experience of trading 38 years, if you try to copy someone, you're going to have a recipe for disaster. What you should do is get sound information, such as what we teach, and then make your own trading decisions. Decide if you want to trade conservatively. Decide if you want to trade aggressively. Decide if you want to trade tick charts. Decide if you want to trade weekly bars. That's how you will get onto that road to consistency, okay? All right, in closing here, I just want to thank you so much. Remember, for more information on what we provide, the education we give you, you can go to the website that FX Street has provided for us. I showed you that link earlier. Or you can go to our sister site here. That's Pro Trader Strategies. They market all of my techniques and courses. You can email them to find out about that 2-for-1 discount we have, or you can call them directly at 310-598-6677. In closing, I want to thank you so much for attending. Thank you so much for listening. I hope you enjoy this free strategy I shared with you today. And I look forward to all of you becoming members of mine and students of mine at Specialist Trading. Thank you so much. We'll see you next time. Bye-bye.